Hey traders, Jason here from Leavitt Brothers. It's time for an update of my State of the Market series. A lot has happened in the last 2 weeks since my last update. We've had another Fed meeting, earnings season is ramping up, and of course the coronavirus is rapidly spreading in China. It's hard to guess how everything is connected, how everything will play out, so as always the charts will be our guide. They'll keep us on the right side of the market, warn us of any trend changes that are in the pipeline. So let's get to the charts, let's see what's going on. All right, so here is the global Dow chart. Overall, it looks very constructive. We have a rally up and then a relatively big dip, consolidation pattern, and then a rally up to the previous high. Looks very good. I mean, this is the monthly chart, looks well set up. I kind of look at this as like a little bit of a cup and then possibly a handle here. It helps that the U.S. is about half of this index, and the U.S. is the strongest market in the world. But overall, this looks really good. If there was trouble brewing somewhere in the world or in parts of the world, it would show up here, and I don't see it. I see a rally up to a previous high, consolidation for a couple months so far. Consolidation can continue, but as long as we stay up here, I think the market, overall the world market looks to be in very good shape. If this thing breaks out, man, we could rally huge. Okay, so don't get too bearish out there. This chart looks great. So that's the monthly. Here is the S&P weekly. Okay, so we had the rallied up, traded in a channel for close to 2 years, accelerated out of that channel. Now I look at it as we have a little bit of a consolidation pattern up here. This looks very good too for a weekly chart. You could draw trend lines and say, hey, we had a rising wedge here that could have broke down, but it didn't. The rally negated it. So I view this as an uptrending market. Accelerates, now it's resting within a range. That looks great. This thing could roll up and down in a range for a little bit here, and that would be perfectly fine. If we do get a dip here, as long as you find support over here at the 50-week moving average, I'd say the market's in really good shape. Okay, so that's the S&P 500. Here's the Russell with using the IWM instead of the Russell index. So we have a rally here. We get support from the 50, 50, 50. This is the 50-week moving average. Then you can see the index kind of straddled the moving average for a period of time. Forms a resistance level, breaks out, pretty much nearly matches its high, and then pulls back. So again, this looks pretty good. Okay, I view this as kind of like a little bit of a cup, and then we have a little bit of a handle here at a higher level. As long as this stays up here, again, like the global Dow chart, this chart looks really good, very constructed. If we actually get a breakout here, that's very, very bullish situation if that happens. So even though we've had a little bit of selling pressure recently, we had 2 down weeks in a row. Last week we got some selling at the end of the week. As long as this thing could hold up here in a range, the market overall is in a really good shape. And if we do get a breakout here, we're going to get a big rally, not just a little one. We're probably going to get a big one. All right, so that's the Russell weekly. Quickly, here is the S&P weekly. Not S&P weekly, it's the S&P daily. I just look at it as we got a rally, comes down, tests the 50-day moving average, and then rallies up to a higher high. Nothing wrong with that. Okay, you can try and look really close for some bearish signals, but you get a rally, you get a dip back to the 50, and then you get another rally to a new high. That's bullish. All right, not everything is bullish though. There are some warnings in the near term. Okay, so the charts I just showed you were mostly longer term stuff, monthly, weeklies. Okay, now I want to show you some things that tell me that in the near term things aren't as rosy. So what we have here is we have the NASDAQ versus the NYSE. The market does best when these two are on the same page. Okay, when they both make new highs at the same time, both make new lows, when they move in sync with each other, the market does best. When they get out of sync, bad things tend to happen. So you can see here as an example, we have a higher high here from the NASDAQ, we have a lower high here from the NYSE, and the market dropped. And if you move your eyes across the screen, those types of setups happen. Okay, whenever you get a divergence between the two, you tend to get a reversal. Here's one at the bottom. Lower low for the NYSE, higher low for the NASDAQ. That put it on bottom. It took a while, but that indeed was the bottom. We're getting a very obvious divergence right now. NAS higher high, NYSE lower high. Okay, the lack of participation, the inability of the NYSE to keep up with the NAS is definitely a warning sign in the near term. All right, here is the S&P 500 down below, and up top is the high beta stocks versus the low beta stocks. High beta stocks are the 100 highest beta stocks within the S&P 500. Low volatility is the 100 lowest volatility stocks within the S&P 500. So high beta stocks tend to lead the way. Okay, they tell you that risk is on. Traders are willing to take on a little bit of a risk. When they head south, when they underperform, the market tends to do the same thing. So for example here, we have the high beta stocks versus low beta stocks. Move down, market move down, move down, market move down, move down, market move down. Now we're getting a pretty obvious divergence here. So besides we got a move down here, which was matched a little bit here, now we have a divergence. We have a very obvious lower high here while the S&P 500 moved up here. Okay, so whether we just have a point top, kind of like this, where the relative strength chart just moves to a high and then just drops, or we have a relative strength chart, which is obviously putting in a lower high, the implications are the same. It's kind of like over here where the market kept going up and up and up, and the relative strength chart went down. Okay, it's something to keep an eye on. Do not ignore this. When money is coming out of growth stocks and going into utilities and REITs and stuff like that, the market tends to correct. So we got to be really careful here because the implications from this chart are not very good in the near term, even looking out a few weeks. All right, here is the S&P 500 up top. We have the 10-day moving average of the NYSE AD line and then the cumulative line. On a shorter term basis, looking out a week, 2 weeks, when you get a divergence, bad things tend to happen. So we get market moving up here, negative divergence here. Okay, market moving up here, negative divergence here. We get market moving up here, which was kind of ignored there. We get a little bit of a dip, delayed dip there, but then the market righted itself. Okay, then we got divergence here, which induced this pullback, but now we're getting another divergence here as the S&P just pushed up to a new high. So again, so longer term, we're in great shape. I mean, look at this. The AD line is just steadily moving up above its 50-day moving average. Everything looks great longer term, but in the near term, we have this last rally here did not come with full support. Market's at new all-time high, and over the last 10 days, number of advancers and decliners have been approximately equal. So this is a little bit of this is a near-term warning that we should not ignore. All right, here is a similar situation. We have the NASDAQ versus the NASDAQ 80 volume line. Okay, the last chart was the 80 line. This is the 80 volume line. Okay, so this one lets the larger companies, the bigger, more established companies, those that are, trade more volume, have more influence. Sometimes you get a little bit of a different signal. All right, so what we have here is a similar. We analyze it the same way. When you have divergences, bad things tend to happen. So we have higher high, lower high, market drops. Higher high, lower high, market drops. Okay. Lower high, higher high, lower high, market came down very briefly. So once again, we have a NASDAQ pushes to a new all-time high, and number of stocks, not number of stocks, but advancing volume versus declining volume is barely above zero, putting in an obvious divergence. Okay, long term looks fantastic. Shorter term, we have a little bit of a warning. All right, here is the NASDAQ versus the percentage of NASDAQ stocks above their 50-day moving average and above their 200-day moving average. Actually, it's the NASDAQ 100 percentage of stocks of NASDAQ 100. So it tells us what the participation rate is. Okay, there's only 100 stocks in the NASDAQ 100. Maybe there's a few more because of stocks like Google. If the market pushes up and you get a, market pushes up to a new high, then you get a certain number of stocks that are above their 50-day moving average. Market pushes up to another new high, but then less stocks are above their moving average. And another new high, but even less stocks are above the moving average. That's a warning, okay? The market could go up in the near term, keep pushing higher, but less and less, if less and less stocks are participating, less and less stocks are above their 50-day moving average, that's a warning. Participation rate is declining. Eventually that weighs on the market and the market drops. Okay, and you can see this was a divergence that eventually led to a pretty big drop. So you get a divergence here, which led to another drop last summer. And of course, we're getting, now we're getting the beginning of a pretty big divergence too. Last week, we've made higher highs the last couple of weeks, and we have a pretty obvious lower high here. Okay, so 2 weeks ago, NASDAQ at a new high, 76% of NDX stocks were at above their 50. Last week, NASDAQ put in another new high and only 60% of stocks. Okay, so a full 16% less stocks were above their 50-day moving average compared to just the previous time. So again, near term, declining breadth, negative implications for looking out over the next week or two. Okay, situation with the S&P is very similar. Okay, what I have here is the S&P 500 versus the percentage of SPX stocks above their 20 and SPX stocks above their 50. Okay, I'll go through this a little bit quicker because it's the same as the last chart. Similar analysis. You get higher high from the index, less stocks above their 20, less stocks above their 50s, and the market drops. We get the S&P, higher highs, higher highs, higher lows going on the way up. Less stocks above their 20s, less stocks above their 50s. Okay, currently higher high last week. S&P hit a new all-time high. Less stocks are above their 20s, less stocks are above their 50s. Okay, you don't want to ignore this. The market could continue pushing higher for a little bit longer in the near term. Okay, that always could happen. But overall, unless this divergence gets negated, the market is going to drop. You can't have less and less stocks trading above these key moving averages and have the market continue higher. Okay, again, it can happen in the short term because you can have Apple and Amazon and such continuing up, and those stocks have such an outweighted influence that they could keep the market, they can kind of mask what's going on beneath the surface. But if beneath the surface less and less stocks are participating, eventually it has eventually it inflicts a big influence on the market. Okay, so overall, if I were to sum everything up, overall the market's in good shape. The monthlies, the weeklies, they're doing well. Even the dailies are trending up and above key moving averages. But in the near term, there are warnings. Okay, the 10-day moving averages of the NYSE AD line, the NASDAQ AD volume line are putting in lower highs. The NYSE didn't match the NASDAQ's recent push to a new high, and the percentage of stocks above key moving averages have fallen off. Excuse me, and didn't match the most recent rally. This all adds up to declining breadth and weakening internals, which can persist in the near term, but will bring the market down if they aren't negated. All right, so you got to be careful, and I'm done talking or else I'm going to lose my voice. So again, thanks for listening. You can subscribe to the YouTube channel by clicking on the red subscribe button, and check out my masterclass in trading at the link below. See you next time.